Securities offered through Cambridge Investment Research Incorporated, a broker-dealer, member FINRA, SIPC. Advisory services through Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Cambridge and Clear Vista Financial are not affiliated. Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions.
For I know the plans that I have for you, declares the Lord. Plans to prosper you and not to harm you. Plans to give you a hope and a future. That comes from Jeremiah 29:11. We've all heard that verse before, and it's a very common verse, often misinterpreted sometimes. But we're going to talk a little bit about that today and how we plan for the future. Hi, folks. I'm Certified Kingdom Advisor Mark Trice, and I want to welcome you to the Spend Life Well Show, where we apply biblical wisdom to your financial life. Thanks for joining us today. You can give us a call or text us at our show line, which is 254-282-0495, 254-282-0495. And of course, you can send us an email at radio@spendlifewell.com. We'll try to respond to those on the show or within 24 hours. And in fact, if Jesse likes your question, we can talk about that on an upcoming show. And of course, I mentioned Jesse. Jesse is here with me as always, our co-host, Jesse Hamilton.
Hey, welcome to the show.
So, Jesse, a lot of stuff's been going on this week.
Yes.
And I was trying to find a comparison to what happened this week on Tuesday with the markets.
Oh, yeah?
Quite an eventful day.
Well, we had a lot of data come out, and we don't know if people reacted poorly or if maybe something's happening at the big players at Wall Street. We've been tracking it, but we had a big move in the market.
It was one of those days, Jesse. Now, you don't remember this because you're way too young to remember Monday Night Football or ABC Sports on Saturday, but Keith Jackson, whenever he would see a good play or an outstanding play that he was surprised by, he would always go, "Whoa, Nelly." And that's kind of what Tuesday was in the markets. It was a whoa, Nelly type of event. What did the markets close down yesterday? The NASDAQ, down more than 5%?
Over 5%, yes.
Over 5% in one day.
Yeah,
S&P
the S&P
was
was
down.
in the 4-ish range.
That was probably the biggest one-day move since we were in the middle of the pandemic. Yeah, so since 2020, and we all remember that time. It was a little bit crazy in the market. So what happened with inflation? I think it came out a little bit higher than expected. I assume, based on what we're hearing from the White House, that inflation was just going to disappear on us in 1 or 2 months. Is that right?
Well, this was a hotly anticipated number because of all the Inflation Reduction Act and all the stuff that the White House has been doing. But the number that we're concerned with here is that it rose 0.1%.
Now that
doesn't sound
whole
crazy,
lot,
right?
Jesse, right?
No.
Yeah, okay, I agree. But we have to unpack that a little bit. Now, over the last 12 months, the inflation's risen at a rate of about 8.3% before we do any types of seasonal adjustments. Now, what was surprising this month was, of course, we're seeing gas prices go down a little bit. And for those of you that are Democrat-minded with little d in Austin, Texas, I'm sorry to say it is not anything that the president is doing to lower those prices. Gas prices are going down because we simply are not buying as much. It's a simple supply and demand equation here. Gas prices, energy prices in general fell over 5% in the month as that gasoline index declined. But the big mover this month was food and also utilities like your electric bill and natural gas and things of that nature. Also, medical expenses have gone up quite a bit. So 8.3%, well, that's lower than the 9% that we saw in June, but still a very high rate. Remember, Jesse, I can't remember, what's the target inflation rate for the Federal Reserve? Where do they want to go?
It's either 2 or 3%.
It's 2%.
2%.
That's their target inflation rate. So anybody, if you've got to know some simple addition and subtraction, 8.3% is a long way from the targeted 2% inflation rate by our Federal Reserve. We got a long
Right.
ways to go.
Right.
And so I think things are going to be a whole lot stickier when it comes to inflation. Now, let's break down some of these numbers because this is real important, I think. In looking at the historical numbers for inflation, I'm trying to find my table here, and
Okay.
for some reason it disappeared on me.
That's all right.
Have you got that there, Jesse?
Well, if you look at the index and you take out food and energy,
Yeah,
it rose 6.3% over the last 12 months. So
but
that's
that's a tick up from July.
yes, it is definitely a tick up
Yeah,
from
and that's
July.
concerning. And
It
the thing that surprised me was that food rose at about 0.7% in August, and that's grocery store food and things like that. Food costs for if you're eating out. I know my family, we've decided not to eat out as much. We don't normally
mhm,
eat out much that much anyway, but it's risen over 1.1%. And if you've ever gone out to eat in the last 6 months, you know that the price of that meal has gone way up.
mhm,
So, things like meats, poultry, fish, eggs, things like that, fruits, all up about 0.5% August. And then even dairy went up. Oh, yeah, the food away from home index rose about 0.9%. Now, these
I've
don't
never heard of that
seem like a
before.
lot. These don't seem like a lot, but when you have a month over month inflation numbers that goes up 0.9%,
Right.
you annualize that and it's almost 11% annualized. And we don't see that slowing down. And I think that was the surprise that the market saw was that core inflation and food costs that keep going up.
Right.
It's now the fuel for gas, the energy cost for gasoline and things that we consume like that dropped a half a point, and that makes up a big part of the consumer price index.
Right.
But the other components there continue going up. So I don't think we've seen the plateau here for inflation, and I think a lot of people are concerned about. Now, Jesse, we watched a speech by the president, and he had the West Lawn of the White House full of people that were
Yeah, it
celebrating.
looked a little bit warm. It was like 80 degrees.
Yeah, the president actually took his jacket off,
Mhm.
and they gave him a microphone, which seems to me kind of dangerous. And keeping him away from the teleprompter would be dangerous. But the White House West Lawn was full of people, or at least the part that we saw adjacent to the Rose Garden. And they were celebrating the Inflation Reduction Act, which actually doesn't do anything to reduce inflation.
Mhm.
And most Americans will not see any impact for inflation um, anytime within the next 10 years. It's all optics, and it's spending more money to fight things that we shouldn't be spending money on. In other words, if we're spending more money, that's going to pump money into the economy, and that's going to increase inflation.
Right.
So it really has the exact opposite effect of its title. This is one of those things, Jesse, not to digress, but we often joke sometimes that the how they name mutual funds in our business are sometimes misleading because they'll do things like the super high growth, low risk fund or
Yeah.
the low price stock fund. And a lot of people are drawn into that. And so I think a lot of this Inflation Reduction Act stuff is meant to do just that. They could have basically called it the climate bill or the prescription drug bill.
Yeah.
But of course, we need the optics for reelection. And it was surprising to me to see a big celebration, especially on a day, big celebration at the White House, especially on a day when inflation was reported that it's still going up.
Right. You would think that if a bill was called Inflation Reduction Act, it would target these things that we just talked about, the grocery stores, the gasoline pumps, the restaurants, but it actually doesn't have anything to do with that. And yeah, it's funny you point that out, Mark, because we were watching that on a news broadcast, and we could hear the president speaking about the Inflation Reduction Act, and then in the banner below, we see the Nasdaq and the Dow Jones dropping 4% and 5%. So it's just a
Yeah, it just doesn't jive. I think one of the things that the president really tried to stress was that this bill will help him reduce the budget or reduce the deficit.
Mhm.
The fact of the matter is, folks, if you don't have the bill in the first place, a spending bill, you're in de facto reducing the deficit. But this is actually going to add to the deficit. It's just going to not add to the deficit as fast as other things might be.
Mhm.
And so it's really misleading. And unfortunately, folks, most Americans will not see the impact of any type of provisions within this bill for almost a decade. And don't let that fool you. And that's the reason why we're talking about such salacious topics here on this show. And we're a family oriented, um, faith based financial show. But inflation is the challenge right now.
Right.
And we're seeing, we'll talk about later in the show, all the other things that might be headwinds for the markets to return. And of course, inflation is guilty party number one.
I feel like a lot of people have gotten more used to it over the past few months. Not that it's any easier for the average American to go out and pay so much for the things that they need in their life, but people are starting to come around to the reality that this is probably not going away for a long time.
Yes, it will last for a long time. And I'm afraid, because we saw some other data as well, that wages have not, real wages have really not changed at all for Americans in the last 2 years. There was this incredible increase in the money supply, or we call it M2, for those of you that are nerds at home like us.
That's like the cash in your bank account, the physical
Yes.
cash. It's all
And
the liquid
what
part.
was what caused that massive increase in the money supply, Jesse?
The government was handing it to people.
Yes, massive stimulus. We were aggressively turning on the printing presses to send everyone money during the pandemic. Now, what, 2, 3 times? I can't remember how many times because I didn't get any of it, but
Uh,
2 or 3 times during
two
the
or three
pandemic.
times, yeah. And
Yeah,
a lot of
and
people got it. Millions of people.
we probably didn't need it. We probably didn't need it. It was an attempt, I believe, to potentially buy more votes. It is not working because even though you've got extra cash in your bank account, or did, when you see prices, and I looked at a chart this morning, Jesse, showing the timeline of when we started seeing the rapid increases in inflation. It was after that second stimulus bill.
I don't
And
think you need
that,
to be a scientist or an economist to figure out why there.
no, you don't. You don't. I mean, money goes into the economy, inflation spikes up. It doesn't take a rocket science to figure out that that's bad for our economy. Now, there are some positive sides to high inflation. The market's going down quite a bit,
Mhm.
is because the Federal Reserve has really been trying to prop up our economy for the last decade. A reset could actually be healthy to the long-term viability of our economic system here in the U.S.
Mhm.
And that's
Doesn't mean it'll
one
be
of the
fun.
yeah, that's one of the positive things that could result from all this, but it's going to be rough getting through it all. And the Federal Reserve is looking for, dramatic decreases in that core inflation, which actually went up this month. Dramatic decreases in that core inflation, and then also a rise in unemployment. We need to start seeing layoffs. And I hate talking about layoffs that way because I don't want anyone to lose their job. But that's what the Federal Reserve is going to be looking for: increases in unemployment, dramatic drop in the core inflation index, and only then will they begin to slow down the pace of interest rates.
Well,
Now,
they have all these lofty goals, and they have such a gap in their target inflation and the CPI data. But what are their actual tools to get there? Because they don't have a very sophisticated basket of tools. That they
right? I
don't
mean,
they don't
and
necessarily control the markets like we talk about.
no,
They
but the markets do react
they
to what the
yeah.
Fed may do. There's an old saying that we sometimes say, "Don't fight the Fed." And the Fed has a number of different tools. They used cutting interest rates during the pandemic to stimulate the economy, to encourage businesses to keep people on board, to borrow, et cetera. They also have the ability of quantitative easing, where they're essentially buying bonds
Mhm.
off the markets, putting more liquidity into the system. But they also have the tool that they're using now, which is quantitative tapering, where they're actually selling those bonds. That's actually decreasing the amount of liquidity in the system. So
Okay.
all those things are really ramping up right now. And we believe, and we've always believed, that it's going to take a while for the Fed to see the numbers that they need to see in order to reverse their interest rate hike policy. Jesse, what are they saying next week? Because the Fed Reserve meets next week for their regular
Mhm.
meeting. What are they expecting the Federal Reserve to raise that overnight Fed funds rate to?
Well,
Or
there's
how much are they going to raise it?
the common consensus right now is about 75 basis points, which is a very large move. I've
And
seen a couple articles that could potentially see it even be an entire percent, which would be unprecedented.
yeah,
But
that would be significant. And everyone's going to be listening to it. The press conference, will be listening to it as well. Tune in next week to kind of hear our take on that part of the bill, or the comments there. But the markets always don't interpret what the Fed chairman's actually saying. They've been
mhm,
looking and begging, trying to look for the slightest hint that they're going to reverse their course and start cutting interest rates again. And what we saw with Jackson Hole in August, and what we saw with the data from inflation that came out this week, I don't think that's going to be happening anytime soon. So, folks, you're listening to the Spend Life Well Show with Mark Trice and Jesse Hamilton. When we come back, we'll continue our conversation about interest rates and inflation and so forth. And we'll also get into some barriers that might be there in the market. Stay tuned. We'll be right back with the Spend Life Well Show. All right. Welcome back to the Spend Life Well Show. I'm your host, Certified Kingdom Advisor Mark Trice, and Jesse Hamilton is here with me as well.
hey everybody, welcome.
And we've been trying to lift our spirits because there was a lot of negative sounding economic data this week that came out,
Mhm.
primarily inflation. And the annualized inflation rate was 8.3%, which is beginning to fall just a little bit month over month or year over year. But you're also starting to see an increase in some of those core index materials that they look at. Food at home rose, the food index rose generally by 0.8% in August. Now, that is the smallest monthly increase since December 2021, but we're seeing a lot of other costs go up as well. So,
Mhm.
even though the gasoline and fuel cost index dropped 0.5% during the month, we see these other things go up, and that's not what the Federal Reserve wanted to see. Now, I think the manufacturing cost index came out today as well. That dropped 0.1%, which is what they were expecting. But inflation, a lot of people think that inflation will just disappear once it's over with. And it doesn't happen that way, because you're on a 12-month lag here. And we really saw the inflation begin to spike in the spring and summer of 2021. And you've got some time there that you've got to work itself out before you start to see that annualized inflation rate begin to fall. And until we start seeing some of these core inflation measures begin to fall, we're not out of the woods. And I think we'll have those prices continue to rise. Plus, we got a lot of factors here that we're running into, like winter.
Yep.
And we've got lots of energy crises around the world, and that's concerning, because we tend to increase, for heating oil, natural gas, things like that. We tend to increase those consumption of those types of energy inputs in the wintertime. So, that's the concerning thing. I think I read the numbers here, and that energy, utility costs, and things like that were up over 1% in the month of August. And that's
Just the 1
huge,
month.
just the
Yeah.
1 month.
Yeah.
And I think we'll see those our listeners can tell us, has your electric bill gone up? And the answer is absolutely. Not just
Well,
the normal summertime, I got to turn on my air conditioner type thing. We're talking about uh, dramatic increases. In fact, we've
I've got a
been
story on
reading.
that, Mark.
Okay, yeah.
I got a personal friend who just moved from an apartment, a one-bedroom apartment, to a small house, and he had to restructure his utilities, obviously, because he moved. And he's with the same company, but since he moved, it was an event where they took the opportunity to raise his prices. So
Mm.
he's paying almost double the rate because he got a really great rate years ago at the apartment. It's been the same. And so he just moved, and his first electric bill came in, and he was blown away. And he just, I mean, it was over 3 times as high. And granted, he moved to a bigger place, but still, it's happening to people, and I've seen it.
I think this is really going to be surprising for those folks that have their nice electric cars, because I was reading into some of this and some of the research on what it takes to charge an electric car over a period of a month.
Hmm.
And the analogy that they use is it's almost as if you're adding an extra air conditioning unit to your house.
Okay, that makes sense,
And that's the largest consumer of electricity is your heating and cooling unit,
especially in Texas.
especially in Texas. And that would almost double my electric bill if I added another AC unit outside. So if we're seeing that utility costs like energy, gas, things that go over a wire or a pipe have been increasing at a rapid rate and still increasing, I think a lot of people are going to be surprised come this fall and winter when their electricity costs and natural gas costs really go up quite a bit. So,
Hmm.
folks, if you're not prepared for those increases, you need to take steps to set aside money for those increased expenses. We talk about, knowing the plans that the Lord knows the plans that we have for us to prosper and not harm us. And I think this show here is trying to help people be prepared. And so we think those prices are going to continue to go up. So we just ask you, hey, let's plan ahead. There's nothing we can do about a higher electric bill. We got to keep warm in the wintertime or cool in the summertime, but we need to
Right.
be prepared. So, here's the number I was looking at, Jesse, for food. The food at home index has risen over 13.5% over the last 12 months.
Wow.
And that's the largest 12-month increase for food since the period back in ending in March of 1979.
And
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 I
that's
know a
where
lot of listeners.
people generally go to save money, is to buy more at-home food.
That's right. Eat out less, buy more food. Um, and then some indexes like cereals and bakery products, and I like my bread, up
Hmm.
over 16.7% over the last 12 months. This is the highest it's been since 1979. For some of our listeners that were alive and adults then, how much inflation was impacting the economy during that time. So, hey, we're there, folks. This is not even though the White House said that inflation was basically flat over August, they tried to blow it off so they could have their party on the west lawn or the south lawn. I can't remember which side that's on. I've been to a fireworks show there, Jesse, to watch them on the south lawn. I think it's the south lawn. So for those of you listeners that were correcting me and you called the station to tell me I was wrong, it is the south lawn that faces the Washington Monument. There, it's a great place to watch fireworks on the 4th of July in Washington D.C. So they tried to throw a big party showing how successful this is going to be. That Inflation Reduction Act will not impact most Americans for another 10 years. Right now, folks are trying to figure out how to pay their increasing bills, increasing costs for going to the grocery store, and it's tough, no doubt, no doubt. So Jesse, let's kind of shift gears here because
Okay.
I want to talk because we had a big sell off in the market earlier this week, and where we had in one day certain indexes like the S&P 500, the Nasdaq were down 4% and 5%, and that's
Right.
a huge move for a one day response to a little bit higher inflation than expected.
It really is, because the mutual fund companies and other companies might tell you that a 4 or 5% move in a year would be great. This is one
That's
day we're talking about.
That's right. So, we saw the market kind of rebound a little bit in June and July, and then we go into August, and the there's a lot of money types that meet out in Jackson Hole. The Federal Reserve is one of those. A lot of other similar central bank presidents and leaders from around the world go there, and of course, Chairman Powell, Chairman Jerome, as we call him, gave his speech where he made it clear, look, market, Mr. Wall Street, we're serious about these hiking interest rates. And I know the market's been running up on the hope that the interest rates would be minor, interest rate increases would be minor. We'd stop them by the end of the year, and by early 2023, we'd start cutting those interest rates. We're telling you, we're serious this time. This is not going to be, let's have the Fed bail out the stock market.
It was one of the few times recently where he was actually quite clear.
Yeah. Yeah. And the market decided to sell off from there.
Right.
And until this last week. And we had a little bit of a run up for 4 or 5 days. And then, of course, the inflation data that came out earlier this week kind of poo-pooed on that party.
Mm-hmm.
So let's talk about some of the things that the headwinds that really are impacting the market. Now, there's a couple of things that are positive for the market right now, and one is that oil prices have been falling since really June. In June, a barrel of oil hit about $120 a barrel. Okay, and oil prices have declined about 30% to the low 80s and so forth. There's some discussion by the White House that they'll begin to refill the strategic petroleum reserves once it gets below 80. That's kind of a positive for oil companies, but we'll see if that really happens. But they haven't been releasing that much anyway. So, but some of this is due to seasonality. Some of this decline is due to demand destruction. We talked about this earlier.
Yeah, we also talked about it in one of our monthly updates on the webinar format. We had a chart of the seasonality as well. We had a chart about the demand, and sure enough, well, it proves the point that this is changing quite a bit.
Yeah, when demand falls, prices will fall, and we've had that demand destruction because if we think twice about taking a summer vacation with our family when gasoline's $5 a gallon.
Mm-hmm.
And that really impacted travel this year, and we saw that price begin to fall in June. Okay, so that's one thing. Another thing that's really been positive for the markets has been that commodities have been declining in price until this last week. We started seeing them go back up again. So
these are things like not beyond oil, all types of commodities, even like
corn,
grains, corn, sugar. And
gold and
also,
silver.
Yeah, gold and silver's in there too.
Right. And so you see those things that are declining in price, and that can be positive for the markets and so forth. We also, interest rates have had a volatile summer, right? And those 10-year Treasury rates, which is what peaked back in June, they pulled back a little bit through July and August. Now we've seen them, and I haven't looked today, Jesse, but I think they were getting close to setting all-time highs again this week, especially after yesterday's market sell-off, and after really Chairman Powell's breakfast speech there in late June, August. We saw it rise again, and so that up and down can have an impact on the stock market.
Well, the 10-year Treasury is what a lot of consumer products are based off of, right?
Yeah, that's right. That's right. And so, well, especially mortgages, car loans, things like that, all pegged to that 10-year Treasury. Jesse, also too, I mean, how much is the stock market down right now? Do you have that number up for us?
Sure.
Sorry to put you on the fly, but it relates to my next point.
Yeah, the S&P 500 over 17%.
Yeah, down 17%. The NASDAQ down probably what, 24? 25. And then Treasury bonds, because of rising interest rate, Treasury bonds, I think I looked yesterday, they were down over 27%.
Yeah, correct.
year to date, our long-term treasury index. So a lot of people think that we've had the stock market's oversold, right? Now, let's forget about the fact that the average bear market, the S&P 500, goes down about 28%. We never hit that. We went down at most 24% on the S&P, and we're down minus 17 right now. So it was not surprising to get a little bit of a bounce after that most recent sell-off after Jackson Hole and Chairman Powell's speech. So that was one thing. So we got a little bit of a bounce last week, and now we've had a big sell-off. It will be, if we continue down a couple more days, and I think the market's up today when we're doing the show here, but if we continue down below certain levels, then we may have to retest those lows of June. And we look at this from a technical perspective, and we don't know what the future is going to hold. We take it on a day-by-day basis. As advisors who use active risk management and technical analysis to help our clients, we're not trying to predict the future, and no one can.
Right.
We know there's a lot of economic data and that's negative that might cause things to, cool off a little more. We'll have to see. You can only respond to the data that you've been given. And I encourage everyone, if you have not looked at your 401ks, if you have not looked at your portfolios, please don't be like an ostrich and bury your head in the sand. You've got to take a look at it, because many people think, well, I'm holding a lot of bonds, so I'm safe. And they open up a statement and they realize, oh my gosh, long-term treasuries are down 27%. That's not the surprise that you want to get right before you're thinking about retirement.
Right.
Take control, take ownership of your portfolio. If you want someone to talk to you about that, to make sure you're not doing anything real crazy or just want a sanity check, give us a call. You can call us anytime. We got the number that you can text us and stuff, but you can also go to spendlifewell.com and visit with us. One of our, you can send an inquiry in there through the website. You can get our number off the website as well and give us a call. Or you just want to come back and listen to other older shows that we've done, and you can get some tips from there as well. Of course, we can take your text anytime, 254-282-0495, 254-282-0495. You can text at any time. We'll try to reply during the show or shortly thereafter. And we'd love to visit with you to try to make sense of what's going on in your portfolio, and are there any adjustments that you might want to make to preserve your capital. Jesse, I think when we come back from the break, I want to get into really, what are some things that might be headwinds for the markets this fall? Things to look out for that might be headwinds this fall with the market. So, folks, we thank you for listening in. You've been listening to the Spend Life Well show. I'm your host, Mark Trice, along with co-host Jesse Hamilton. When we come back, we'll get into this topic of what are the headwinds for the stock market this fall, and what you can look for in your portfolio. And we thank you for listening. When we come back, we'll get into that topic. Thanks for listening to the Spend Life Well show. We'll be back in just a moment. Well, welcome back to the Spend Life Well show. I'm your host, Certified Kingdom Advisor Mark Trice, and joining me in the studio, as always, is my sidekick and co-host, Jesse Hamilton.
Hey, welcome back to the Spend Life Well show.
So, Jesse, we've been talking about, what might be construed as like a negative things. I like to put a little positive spin on them, but
Right.
we want you to be prepared. We want you to be aware of what's going on so that you can protect your savings. I think the scripture really is clear about we don't need to be passive in our investment management. We need to be active and being good stewards. And that means to evaluate the data that we've been given and make changes if necessary.
Yeah, I like that you're trying to put a positive spin on it, because it can be kind of depressing hearing a show here where we just keep talking about how inflation is skyrocketing and all these prices are unaffordable, but that's not necessarily the way that we want to come across. But we do have 10 headwinds here for the markets moving forward, especially relating to the fall and the climate of the country we live in right now. So let's dive into those.
Well, I want to, but I want to say, we might it may the information we're presenting may seem negative to you, but we see it as opportunity.
Right.
If we think there are things that are impacting the markets or impacting the economy, there's an alternative to fight that, and you need to be working with a qualified financial advisor. And there's a number of, especially certified Kingdom advisor financial advisors in Central Texas. All you have to do is go to kingdomadvisors.com, click on the button for find a financial advisor, and that will be linked up to where you live or closest one there. Give them a call, talk to them about your situation, and you'll know, because they're a certified Kingdom advisor, that they are looking at your finances through the lens of a biblical worldview. And I can't tell you, we support the Money Wise program, which is here on the bridge every weekday at 3 p.m. The host, Rob West, is a friend of us, and we know him through Kingdom Advisors. A great guy. We love listening to that show every day. It's one that we don't miss. So I encourage you, if you want some more direction and advice, listen to Money Wise every day, 3 o'clock here on the bridge, every Monday through Friday. But Jesse, so let's go through, because we've identified 10 potential headwinds that might
Right.
lie ahead this fall for the stock market.
Yes, we have. And once again, we are not a political show, but sometimes the paths cross. So the first point we have here is the upcoming midterm elections, and anticipation of which party is going to have control and whether that's going to have a major effect on the market.
We have a lot of people call us all the time and ask us, like, I mean, it's almost every election cycle, Jesse, isn't it? I mean, every election cycle, we will get a few calls that will say, I'm concerned about who gets elected.
Hmm.
Now, we usually say that don't worry about that, because we're going to figure out a way to help you navigate that no matter what.
Right.
So we don't really care who's in power in Washington. We just want to know who's in power. And that uncertainty can create some volatility in the markets.
Right.
So this could be exacerbated this fall because there's so much contention between the two sides, and there's a lot of people coming up for reelection, and that once that election ends, it immediately starts the presidential election cycle, and who knows what's going to happen with that. So
Hmm.
that's one thing we're thinking about. What's the second one,
Hmm.
Jesse?
Well, we have the upcoming Fed meeting, which
Yep.
is scheduled to happen this next week. And it's going to be an interesting one for sure. People are heavily anticipating it, especially after the forewarning at Jackson Hole. We expect the Fed to raise interest rates, but it's also possible that they might only raise them a half point or maybe more. We don't know.
Yeah, and that's the uncertainty. I think they've been communicating, all the different regional Fed presidents have been communicating this last week, that it's at least 75 basis points or
Hmm.
0.75%. And so anything more would be a surprise.
Right.
Anything less would be a surprise, signaling that the markets the economy is decelerating a little bit faster than expected. So
Hmm.
pay attention to that. We'll certainly talk about it next week on our show,
Right.
but pay attention to that. What's the next one?
Well, in the market, we have the bulls and the bears, and then we have the hawks and the doves. And our next point here is hawkish Fed speak, which
Right.
means the Fed being aggressive about interest rates.
Yeah, I think Chairman Powell said last in at Jackson Hole that they would be diligent and not stop until it's over. Now, they really can't tell you when it will be over, but they have to look at a
Hmm.
number of different factors. And quite honestly, folks, the Federal Reserve has a history of overdoing it in both directions. Being too dovish and being too lenient on interest rates, and being too hawkish and being too aggressive on interest rates. So
Right.
they're trying to navigate what they call the soft landing, but we will continue to see that and know that the markets are watching every word that they say.
Hmm.
So
So
we've had a little bit. The fourth one is the CPI, the Consumer Price Index, that came out this week,
Right.
and
We already
that
talked
would
about that.
yep. And so we talked about that at length, but also GDP. Is the economy, gross domestic product, is the economy growing in the third quarter? We won't know that until sometime towards the end of October, but we got to watch out for that.
Right.
Now,
So
one of the things that's really important, Jesse, is a lot of people have been doing what? They've been pulling their money out of the market.
yeah, we've seen huge outflows of money in the stock market.
I saw the name, and I can't. It's the National Association of Independent Money Managers, I think is what they call it. Has a weekly survey that I actually participate in, but the results from last week were showing that on average, um, these independent money managers only had about a 37% exposure to equities.
Hmm.
And that's really revealing that people are really generally concerned about the future of the stock market and what's going on.
Yeah, this is happening from the Wall Street giants all the way down to the average Joe trading on his app. We see it
Yeah.
across them all.
So that's one thing. There's been a record number of outflows during the month. So
Hmm.
then we got to look at geopolitical surprises, right?
Yes, that is very relevant today.
And inflation overseas. I think we
Hmm.
saw Turkey last month. Was it 48% inflation in one
That's
month?
it's painful.
And then I think Brazil is pretty close, but not that close behind, having average annual inflation right now about 78%.
Hmm.
You know, folks, this is going to result in some political unrest in foreign countries. So, you know, if you see on the news that there's riots in Brazil or riots in Istanbul and in Turkey or whatever, you'll know why, because people are finding it hard to survive because inflation's going up so much, so
Hmm.
much.
Right.
What about our friends in China, or excuse me,
They
our adversaries in China?
yeah, they're facing huge inflation as well. And not to mention all the tension going on between the United States and China right now, but we get so many of our goods from them. So it's extremely impactful to our country as well.
Yeah, and things like a rising dollar are impacting that
Hmm.
trade balance.
Yes.
You're also seeing the economy in China slow down when if they're not showing us a really high single digit number or a double digit number as far as the growth of their economy, because we know it's the numbers are cooked, they're not accurate, then things must be pretty bad. So we're
Hmm.
seeing potentially a contraction in China in
Hmm.
their economy. I mentioned earlier, Jesse, the eighth thing, and that's the dollar strength. Can you talk about that?
Sure. The dollar strength has huge amounts to do with how we trade with foreign countries. So if you have international type of investments, that's what's going to be affected by the price of the dollar.
Yeah, and when we see the dollar fall, we see international type investments tend to do better.
Hmm.
The dollar's been going up quite a bit in the last several months. I think this last week we had a little bit of a pullback in the dollar.
Hmm.
We'll have to see how that impacts international equities.
Right.
And speaking of companies and things, a lot of public companies in the United States have been downgrading their earnings expectations.
Hmm. They're trying to make themselves look as good as possible in a really challenging market.
You know, it's always funny because I worked in Big Four accounting. I'm not a CPA or anything, so please don't call the show and ask a tax question. But I was reminded and saw there firsthand about how much, you know, public companies really try to pitch the right message. And one of the best messages they can pitch, because they want their stock price to stay up or go higher, is to beat earnings expectations. And what we saw in the second quarter with second quarter results from a lot of public companies was we saw some companies deciding to not even give any forward earnings expectations,
Hmm.
and other companies decide to downgrade or lower their future earnings expectations. And part of that, Jesse, is so that when those earnings reports come out for the third quarter, which we'll see in November and early December, perhaps they'll beat expectations, and that will make everyone happy, and the stock price will go up.
And the
But
headlines will be positive.
yes, there's a lot of massaging of data there that companies are allowed to do. So you have to kind of read between the tea leaves.
Hmm.
And then finally, Jesse, the 10th thing is really, we're seeing a lot of that now, is that potential slowdown in housing.
Right. We mentioned the treasury, the 10-year treasury keeps increasing and being volatile. That's going to slow down people buying houses. But a lot of people ask, are we going to have 2008 again? And there's no way to tell the future, but likely not another crash, quote, but we do expect a slowdown.
And we're already starting to see that. I was talking to a real estate expert just yesterday, Jesse. We were
Hmm.
both talking to him, and basically he was saying you're starting to see dramatic price reductions in listings in both the
Right.
Austin, Texas area and the Boise, Idaho area, and that is kind of indicative. Now, Texas really didn't go through the housing bubble back in 2006 to 2009 in there. We didn't experience that. And part of that is due in part to our laws and restricting about how much people can borrow, et cetera. But we are starting to see those prices begin to fall. And so, maybe now's not the best time to sell your house. Maybe it is the right time for you. You need to talk to a professional realtor about your situation and what might work there. But when interest rates rise, a couple of things happen. Number one, prices have been going up quite a bit. So when
Yeah.
interest rates rise, the average person can't afford the average house. And we've talked about this on a previous show. The average person can't afford the average house. And so prices have to fall in order to accommodate that until interest rates begin to return back to, well, they're really not that high, Jesse, but they've been so low lately that these increases have sometimes added 30% to a monthly mortgage payment, and that makes
Wow.
it unaffordable for some people.
Definitely.
But don't worry, the government has come out with a number of different programs to allow, and it sounds eerily familiar to 2006 and 7, to encourage people of minority or disadvantaged communities to buy houses with no money down and very low interest rates. So that I'm being a little bit cynical here, folks. That just seems like a setup for 2006 and 7 all over again, uh, causing people to buy houses that really are not ready to buy a house. So it's going to be interesting to see. It's going to be interesting to see, Jesse.
Hmm.
So Jesse, do we have any questions from listeners we want to take in our final minutes of the show?
Well, we have one specifically. It's not necessarily directly retiring or financial planning related, but the question is, should I take a job that pays more? It might have a larger commute and some other downsides, less time with my family. But if I can make more money, I can save more for retirement, and then I can retire sooner. So should I
Yeah.
make that choice?
Yeah, and I think I don't know who that was from, but it was a good question. Um, and it often happens. People get a chance to take a job that pays more. It might require them to commute further and things like that. There's a trade-off, Jesse, and the trade-off is between the value of your time and the value of your family.
Hmm.
And we were talking to somebody just last week, and they were experiencing a similar dilemma. What do they do? And there's something that needs to be said about being able to spend time with your family. I'm guilty, Jesse, of being one of those guys that chased the paycheck years ago,
Okay.
and I regret it. Even though I made more money, it put me in a situation where I got to spend less time with my kids.
But
And
if you make more money, then you can retire sooner and hang out with them then, right?
yeah, but I think it's a big trade-off. I think it's a big cost. I really do. I think family is important, and I think it's important to put priority on that. And I'd rather do with less than give up time with my kids. Not just my opinion, and I think maybe many listeners would agree with me. Some may disagree, depending on their situation. But
Hmm.
I know it's a hard question. We'll certainly pray for you and ask that you pray as well, and hopefully the Lord will guide you as to what's the best decision for you and your family. Well, folks, we're coming up on the end of the show, and I know we said a lot of things that might make you worry, but remember the Lord says, "Do not worry." So remember that. We pray for you this week as you go throughout your work week. Enjoy your weekend. When we come back next week, we're going to talk about how much the Fed raised interest rates. Jesse's and I are going to have a conversation about, with all this negative stuff, is it a good or a bad time to retire? So I encourage you to listen in. Jesse, thanks for joining us as well every week. And you've been listening to the Spend Life Well show. Have a blessed week.